Welcome to Pro News Weekly. Let's dive into the latest updates on the financial markets. The dollar index fell to 106, retreating from the lows of early December. The momentum against its major rivals was not clear as the euro stalled, the pound gained, and the Canadian dollar retreated. Technically, the DXY retreated to the 61.8% level, a typical Fibonacci retracement. The bears have already recaptured the 76.4% level and sold the index below its 50-day moving average. However, the current test is not an easy one, as it is the peak area of the last 2 years. The growing caution in the financial markets is playing in favor of the dollar bulls, creating a demand for global profit-taking that will boost the U.S. currency in the short term. At the same time, a gradual increase in expectations of a softer Fed policy is working against the dollar. Markets are now pricing in a 5% chance of no change in the Fed funds rate by the end of the year, down from 16% a week ago. The probability of 2 or more rate cuts has risen to 73% from 48% last week. Extreme fear is driving U.S. stock indexes, according to a popular CNN business index. Their index has fallen to 21, the lowest since early August last year, when markets saw heightened volatility. An area of extreme fear is often seen as an attractive time to buy. However, in both August and December, the lows of the Fear and Greed Index were well ahead of the market bottom and would have forced rash investors to endure several anxious sessions. It was much more rational to stay on the sidelines and join the rally only after the sentiment index had risen sharply out of fear territory. At the start of the week, the S&P 500 fell under 6,000 in its 50-day moving average. Since the second half of January, it had been heavily bought on touching this curve, but the buying strength was clearly not enough to push it further into historical highs. At Tuesday's low, the S&P 500 was close to the lower boundary of the ascending channel that has been in place since late 2023. A break below 5,900 could trigger a broader sell-off in equities well beyond the U.S. An even more dramatic scenario could be triggered by a break below the 200-day moving average, now at 5,750. At the same time, the basic scenario in such cases is still a rebound from the lower boundary and a move towards the upper boundary, which is now above 6,600. The subdued VIX temporarily favors the bulls, unlike it was in August. This volatility index stays below 20, the level above which is often the first signal that the market has switched to sell-off mode. Gold has seen its first decline after 8 weeks of gains. After starting the week with an attempt to renew its highs, the precious metal has been hit by a more intense sell-off. We saw a similar dynamic at the beginning of February, suggesting that sellers are very active at current levels. The increased push into U.S. government bonds well explains this momentum. Investors moved into long-term U.S. Treasuries in response to the many initiatives by the current president's administration to reduce the national budget. The market reaction is not a measure of the effectiveness of these initiatives, but it is sufficiently focused at this stage. The potential pullback in gold allows us to consider the 2,800 area as a potential target for the current downside momentum from 2,955. This is the area of the peak at the end of October last year and the 61.8% Fibonacci retracement level. A break below would signal the beginning of a reversal to the downside. The cryptocurrency market stabilized in the first half of Wednesday, but by the end, a new wave of sell-offs began, leading to new lows since early November at $2.75 trillion. In the morning, attempts were again made to stabilize the market. Increased trading activity was accompanied by increased volumes, indicating both accelerated liquidation of positions and interest in buying on declines. The Fear and Greed Index fell to 10, which is an indicator of extreme fear, and was last recorded in June 2022. The index has only been below this value for 19 days in its 7-year history. While the indicator is intended to be a good buy point, Experience trading other markets suggests that this may be far from a lower price point. Bitcoin is trading around the $86,000 mark, although the previous evening it was approaching $82,000 and touching its 200-day moving average. Earlier in the week, the consolidation pattern was broken, and now market participants are trying to determine the endpoint of the decline. Unusually, the largest altcoins remained within the range established the day before, despite the significant decline over the week. An extremely eventful week of macroeconomic events lies ahead. On Monday, flash consumer inflation estimates for February are released across the Eurozone. Overall inflation has increased in the last 5 months, rising to 2.5% year over year. Core inflation has been flat at 2.7% at this time. That's high, but without its acceleration, the ECB may keep its focus on cutting rates to stimulate the economy. On Tuesday, Britain announced its annual budget, which could affect the pound and British stock indices. On Thursday, the ECB will decide on the key interest rate, likely cutting it another 0.25 percentage point. However, if inflation surprises upwards, the decision will become unclear. A cut and a willingness to slash the rate further could put pressure on the euro, ending the USD consolidation period near 1.05. The US labor market figures will be released on Friday, which could turn the previous dynamics upside down and accelerate the ongoing processes. Keep an eye out. It will be interesting. Stay tuned to Pro News Weekly for more updates on global markets. Like, share, and subscribe.